Thank you, Scott. I really appreciate it. Yeah, so I am going to go a little bit about the why, but I think let's look at the what is available. We did understand the platform is going to give you access to commercial real estate, but I really wanted today to actually show you what are the different options available in the basic commercial real estate sense. What sectors are we looking at? And then I'm going to go look at it. What's the associated risk, and maybe trying to tie it back a little again on the income proportion, the capital growth, and maybe try and give you a little bit of a asymmetric risk to reward tangible thing to take away for the day. So we're going to talk about some of the fundamentals in the commercial real estate. But before I go, I just want to say, yeah, we're going to give you as much information as possible, but we don't provide any financial advice. We do implore you to go to your financial advisors, your tax professionals, to consult with them as well, to make your own decision at your own discretion if you want to participate with us. So just a little bit of a disclaimer saying everything we do here is to provide you transparency with everything, but we don't advise you on investing with us at all. What I'm going to take a little bit of look, we taught you guys a little bit earlier on who Tony Robbins is and really how he in the book showed you to how you can really start creating a unshakable or unwaverable portfolio in any type of economic situation. We had that really long and complicated quote from the guy called Ray Dalio, who said, listen, if we really want to have an all-weather stormy portfolio, we need to have 15 uncorrelated bets. And I'm going to actually end off my presentation showing how the platform really can allow you to start building from that and build a longer-term strategy to be actually unshakable around the globe. Doesn't matter what economic situation unfolds in your personal life. So I think what I wanted to share, I mean, can anybody actually recall the four other principles, the four core principles that Scott mentioned out of what really is a fundamental thing you need to have to be financially successful? Anybody willing to venture a couple of guesses? Yeah, sure. Don't lose money. Yeah, so that's rule number one, and also Warren Buffett's basically principle he lives on. Anybody else want to guess something else? Sorry? You need a plan, yes. Tax efficiency, that's a very important thing. So we're not going to give you advice on how to do that, but the platform has been set up as an initial start point to make this already tax efficient. But everybody has got their own reasons for doing things and also need to consult their professions. But there's no point in undertaking amazing investments and actually you just give a third of it away to deal. And this is really what makes real estate for us a very appealing investment sector to get involved in. It's a hard, tangible asset. we did say if something goes wrong, your asset will never liquidate to nothing. It will always have some form of value. So even if the worst case scenario really unfolds, you can maybe still get 60 pennies on the pound or 60 cents to the dollar. And into that, so that's a really big wealth protection tool, and that's why we fundamentally love actually real estate. Going to go in a little bit more on the, as I said, the options you have available though. So the commercial industry, it's a really widespread industry, and I thought, listen, let's maybe just touch on some of the basic sectors that you can have as an option if you want to really pursue an investment strategy in the commercial real estate. So if you look at the categories, all of us are pretty much familiar with 4 of these 5 sectors, and we did now a little bit to touch about on what multifamily is. But if you're looking at entering this sphere, these are the 4 main categories that you can get into. It can get quite complicated because all of these actually are divided into subcategories into that. But what I'm going to try and show you, what are some of the fundamentals to understand associated with this to get a decent return at the end of the day. So just giving you a little bit of idea, the favorite sectors that we really love in the States specifically, you know about our story about the healthcare, that's really appealing to us. We're starting to notice there's a big trend going into industrial space as well. Specifically, if you consider what's happening in the retail space, a lot of the people are actually with the e-commerce, there's a lot more focus on moving tenant demand to industrial space on the distribution and the logistical side. This is really underpinning why we think this is actually being a good focus on investment in the future on this type of sector. Multifamily has also been a well-performing asset class, and that's our 4th favorite still to consider in a long-term strategy. It's still, as we said, the 2nd best performing asset class in America for the last 5 years running. These are just some of the other categories that are available into that and the favorite ones that we go. So retail is available. There are certain, can I say, special cases that retail still can make fundamental sense to get involved with, but it's really probably 1 out of every 20 deals that come across our deal that we really would consider going into that as a point, as a diversification tool, getting into different sectors. What I really wanted to show you, so we did have a talk. This is a deal that we did in Texas just to show you. In South Africa, it's similar to what we know as an entire complex of or estate. The difference between this is it's actually owned under one title, and you own all the doors, and it's not similar to what we understand in South Africa as having sectional title holders. you're willing to make a big risk to take a big risk to obtain a good return. This is typically, if you look at the multifamily type of deals, you buy a distressed asset, the owner really has let go of the thing. The rent roll is not really well, and we actually get the partners that are well versed in the sector to take over that asset, buy it at a little bit of a discount, but then we know there's going to be a lot of hard work to turn this asset around. But if we manage to do that successfully, really at the exit, your majority of your return is actually based on the value add and the capital growth that you get on the exit of the deal. So this is more a little bit for the adventurous type of investor, but there's still a good stability because there's actually some income still involved in the deal. Sorry, I just want to get some water here. And also looking at the last category on that side, the opportunistic is more if you like have a look at the deal of developments breaking new ground. Yes, there's still a lot to be done in the value chain of real estate, but once again, the execution, the parties involved, a lot of moving parts, a lot of variables that still need to actually all execute successfully to really make this thing work at the end of the day to really give you a proper return. So us as Wealth Migrate really started focusing only on these three core principles. We really started, and Benny Besaidnet and the guys said, listen, we're not really looking to get into any type of opportunistic deals. We're really veering away from groundbreaking developments. We're going to stay and buy stable asset classes which really got existing income in place. And with the markets and the fundamentals that the platform now can really bring, we will show you what's the bigger difference and actually getting asymmetric risk and return rewards in stable sectors. So what I've really done here is just to give you an overview. So I gave you the 4 different sectors and now the categories associated with it. So what I did is actually in my first little column here, I show you what's the associated annual, sorry, I don't know why it's so jittery this morning. I'll show you what the annual associated returns to those different sectors and components into the real estate is. But similarly to that, I want to actually show you what's the income profile on each of these sectors to give you a little bit of a spectrum to understand. I go and look at this entire commercial real estate, but I want to understand what's my associated risk, what's the guarantee of certain incomes, and where my real return actually comes from what type of portion. So you can have a look, stable medical core assets where we buy 100% leased or 95% leased assets with long leases in place, we can really expect a really stable annual return of about 10%. Why that's really appealing to us, because in the position to offer you a good return of a good price for this property, but we're really going to bundle this together and actually make it available to new investors or the existing investors to roll over into this deal. So this deal, actually, they want to buy our share out for just less than $60 million, but the entire portfolio that they're bringing together, they're actually bringing two or three buildings into this entire portfolio, and the total deal value of that is just over $100 million. As I said, this is the first full investment cycle that we've completed now, really giving you confidence that we can actually execute on the strategies that we tried to employ from day one. And if you invested with us in all of those projects from 2014, you would have received an average cash on cash net of 9.62%. Capital growth in all of those projects, some of them were at 30%, some were at 80%, but if you invested in all 4 deals, you would have received a total return of 61% capital growth in that property with a 1.64 multiple of your original investment. So I just thought I'd maybe show you a little bit of a graph. If you invested in 2014 with us, this is the income profile on all of those deals, and obviously the big capital growth that we got at the end of the day. Just showing you, listen, if you started this journey off where you would have stood today, really successfully executing that. So you will notice I actually took an investment portfolio holding of $400,000. Reason why I did that, when we started in 2014, the platform and the technology was not really yet in place. But if you wanted to participate into these deals, it was available at a minimum of $100,000 per investor. And now the significance is that the investors who started to walk the journey with us is actually really excited because, yes, they might have had the access and the capital to get involved into that, but now the technology really offers them the solution to diversify. So not only can they still invest in the same type of asset classes, but if I have $100,000, I don't need to put everything in there to participate. I can take that exact same $100,000 and put it into 10 different deals, and by that exact same measure, we actually start diversifying our first investments, and that's what the platform really can do. And I'm going to show you a little bit on what's the bigger effect of that. So, as Scott mentioned, it's really important. We just, as Wealth Migrate, don't think, listen, we're going to fly to the States and get the best buildings. We really try and partner with people who are on the ground, has a good track record, has done this successfully. But another key criteria from the investment committee perspective, they have to be a niche player. We don't want somebody with a long record, but the prices really push up. And it's quite similar to what's happening in Cape Town, actually. If you buy an asset there, you gross yield 3.5% to 4%. What that means is, why is it still a the head office for them? And what they've actually done is said, listen, we acquired this building in 2016 already, but we're willing to give you a participatory interest to get you a feel on what we can really deliver with us. And they said, we bought this deal for about $61 million, but we're going to give you 3.85 to participate in the income portion of the property. So we said, okay, that's 100% fine, but what we really want is to, if we look at this deal, we actually successfully negotiated a guaranteed 8% per annum for the investor. So if you go into this deal, it's only a 36 months deal. You're going to get a guaranteed 8%. Well, not guaranteed, but close to guaranteed, because we agreed that is what they have to deliver to us. And they said, okay, that's fine, and we will actually be willing to buy that equity slither, this 3.8, back at a little bit of a premium for 20%. So we already predetermined what's going to be the income and the exit when we started the deal, which is a little bit more. Guys said, listen, why don't we just actually take what the deal can offer, maybe get a 9% and the 30%. They said, no, this is more of a reputation and a trust building exercise. They've got a massive pipeline, and they're going to be our main supplier of the medical properties in Atlanta and in and around the States. But they said, if we can really give the guys the confidence that we can offer and deliver on what we project, it's also about building the trust, because they see where the platform is going and where they can actually also benefit from that in the long term. So this is a deal that's live on the platform at the moment. It's actually, we launched it now in January. There's about still $2 million of equity available, and this is open for anybody to start participating from as little as $1,000. Just a little couple of pictures. So what's really significant in this strategy, there's just opposite this road is actually a main healthcare provider, and that Northside Hospital group is sitting there. So what they actually did, they bought this entire parcel of land with the deal, with the improvements on it and the adjacent land. So this is actually a first phase of a much bigger development, and so there will be multiple opportunities to invest in different ranges of the investment spectrum. But they said, listen, there's a bigger strategy, but we're going to give you a bit of a fixed type of return on this to really build the rapport, and if people want to really start investing with us in the future, they understand what we can deliver. These are just a little bit of the figures. This is the industrial building in Brisbane. As I said, it's a 5 to 7 year investment term with a cash on cash average of 7.5%, and as I said, an IRR of just over 10% on that deal. Looking at the living works, it's an 18 months turnaround once again, because it's an easily executable strategy. It's a shorter turnaround, and if we're going to actually on the entire deal get a 27% return, but because it's 18 months, that's why it actually equates to an annualized return of 19.31%. So Scott mentioned what's the difference between the REITs and funds and syndicates and what we can really offer. But I thought just maybe to give you an indication, the real difference is what the platform can give you is it gives you the deciding power on what I want to do with my money. You're not at the peril of a fund or of a fund manager sitting here and say, listen, we need to work on this cash because we've raised X amount of dollars, $200 million, we need to distribute it now for you to get your monies working. This is why we fundamentally believe this model is really flawed, and we really created the platform to put the power in your hand and say, I can choose what opportunities I want to partake in. If I don't like the first two properties, the medical side, but I'm more a little bit adventurous, I can decide where my money is going, and it's not really at the peril of a fund manager. And this is I'm going to show you what the effect of this really is, as opposed to investing with a REIT where you're actually dependent on the sentiment of that share value. Remember we said that the REITs are actually 70% correlated to the entire equity market because there's an active secondary market for and demand and supply for that. But what is the one biggest downside of having liquidity in any investment? Can anybody maybe venture a guess what's the biggest downside of having liquidity in any type of investments? Liquidity does not come without a premium. So if I'm willing to go into an asset and I want liquidity, I'm not necessarily going to get the true reflective returns onto that. So I'm willing to pay a premium to be able to get out earlier than what we really want. And the difference, what I want to really to show you is actually bringing you back to what Einstein said. It's all about staying in the market for the longer run to really make this compounding effect work for you. And this is where Wealth Migrate and the platform really is going to make a bigger difference. So what I've done, actually done a little bit of an exercise. So just take in consideration, I've given you the 5 deals or the examples of deals that will be available on the platform. And I said, listen, if we start following a longer term strategy on the investments, what is the potential we can really expect to achieve on a normal commercial real estate asset, what we're going to do? And I'm going to show you investing from quarter 2 and quarter 3, that small margin of equity that I already built up on the income, this is a little bit of the difference it already makes. So this is not really compounding yet. It's just the first leg of compounding, and it already makes about a $70,000 difference in 10 years. What I then actually said, listen, because we're going to start in quarter 1 and quarter 3, so each project actually has the exact same exit. So if I start here, let's imagine a timeline. My first deal is actually going to end here. So my first capital event is here in quarter 59. Quarter 60, actually, what's the beauty about this? If I start every quarter, from quarter 60 onwards, every quarter I'm going to get a capital event. So I'm going to get another 26% that I can actually start reinvesting and start earning another 8%. And you can kind of see where the momentum is going to go with this. So this is what the bigger picture actually looks like. If I religiously do not touch anything but still follow the exact same strategy of doing $10,000 per quarter out of my pocket, if I do this for 10 years and reinvest everything at the end of the day, look at the difference it really does make. If you look at this gray line on the chart, this is where things really start becoming exponential, and where, if you just think back at school days, the logarithmic curve really starts making a difference on the compounding effect. So this takes in consideration, okay, I'm reinvesting everything at the moment. There's capital events that's happening here, and I'm starting to reinvest that. I'm still getting 8% on that. And I made an assumption on this, really, that it's a hard exit at year 10. So my portfolio, consider from year 5 to 6, I still regularly put my own $10,000 in, but with the accumulated capital, I reinvest that as well. So from year 5 to 6, I also put in $200,000. But what I got from that total $200,000 is accumulated income of $909,000. What this really means is you will actually, on that second portion of the same 200 I put in, you will get 4.45 times the money of your original capital. And this is where it starts really to make sense. The technology is going to allow you in a single place to start running a diversified portfolio across currencies, across geographies, and across sectors, and everything is there on one executable platform. And we really wanted to show you what's the difference and what we can really bring you if you follow a longer term strategy at the end of the day. What's the bigger picture if I do this? If I have a look at option 1, if I didn't reinvest anything, my portfolio would have grown to about 300. Okay, perfect. If that's it, I think that's just my time today. What we're actually going to do for you, we will be sending you a link today to just give you a little bit of an idea and to understand what are your needs and your analysis. So if just maybe 2 minutes of your time to get in feedback on, listen, what do you want to really get out of this platform to understand your individual needs? We'd really appreciate your